Anastasia Amoroso, Managing Director, Chief Investment Strategist at Partners Group. Anastasia, great to have you on set.
Good to see you, Brad.
Before we get into all the stuff you're here for, any reaction to what Jerome Powell had to say?
Well, I think this is very supportive for both the short-term rates and also the long-term rates, because he clearly expressed concern once again about the weakening of the labor market, which means we are going to cut rates most likely in October and again in December. And at the same time, he's talking about ending the balance sheet runoff and potentially supporting more buying of long-term treasuries. And so that certainly should be helpful to long-term yields as well. And this is really critical, Brian, because, you know, the pushback that I sometimes get when I talk about the lowering of short-term rates is that, yeah, but markets get priced off some of the, longer-term expectations. So the fact that we may have scope for yields to fall across the curve is really supportive for a range of assets.
Dare we call this quantitative easing?
No, not yet. I mean, this is reminiscent of what eventually ended up happening in 2018.
Yes, it seems like everything starts somewhere. When I hear buying bonds, bringing down long-dated Treasury yields, I'm thinking, sounds a little bit like QE.
Look, it's a tool in a toolkit, and we're not quite to QE yet, but it is certainly the sign of the times, which tells you that there is more and more concern building about the labor market, shoring them up, because if you don't do it quickly, perhaps with a range of tools, then you may have to do more later. So I'm not surprised that more and more of those tools are getting activated.
This is probably the dumbest question I've ever asked, but there's a part of me, and is there a part of you that thinks Jerome Powell, listen, he's a human being, he's going to be gone in a few months, wants to go out liked, right? There's an element, I wonder if there's an element of human behavior that's going to just lean him toward less conflict, going out kind of on top.
You know, maybe there's that, but maybe there's also this notion that he has been successful against all odds in delivering the soft landing. You know, so many people have doubted him on that and the Fed on the ability to execute that. But here we are with the economy in the third quarter on pace to grow something like 3.5% again. You know, they're on the cusp of lowering interest rates. The labor market is still okay. And if he can invoke the set of measures to actually make sure that we maybe soft land the economy once more, soft land the labor market, maybe that's the legacy.
Maybe it is. But we forget Jerome Powell is actually a man. His heart pumps blood. And everybody, I think, mostly wants to be liked. All right, let's move on to the reason that you're here. I know it just started, okay? We had a few banks come out this morning, Citigroup in particular, Wells Fargo. First inning, half of first inning, you got to like what you see so far with earnings.
Right. I like what I see, for sure. It's beating expectations. And, the 4 or 5 or, 6 companies that reported, the headlines are all very positive. But, Brian, my point is that the bar has been reset higher going into this earnings season. And for example, banks was one of the sectors that had actually the greatest upwards revisions. And so I do think it becomes more challenging. And if there's any mention of an additional risk that wasn't already priced in, then the reaction is maybe not as positive as you would expect. And of course, what I'm referring to are JP Morgan results, for example, being broadly positive. And yet there's some concerns about the credit markets. And that's what the stocks ended up reacting to.
All right. You saw that little graphic that we had. If you're on the radio, by the way, we had a graphic that said technology is basically going to be the biggest part of earnings. We all know that. I want to play something for you. Earlier today, BlackRock CEO Larry Fink was on CNBC this morning really talking about the AI build-out, but he also talked about winners and losers. Listen and respond to what Larry Fink had to say.
I don't believe this is a bubble, but I believe this is capital that in most cases is going to be well spent. That being said, will there be 1 or 2 failures in that? Absolutely. And that is capitalism. We're going to have some big winners and we're going to have some big losers.
So that caught my ear. Big winners, we know. We've already had them, by the way. But when Larry Fink, arguably one of the most powerful people on Wall Street, says big losers, he's got my attention. What's your take?
Yeah. I mean, look, we agree with that view. AI is one of the greatest commercial opportunities that we have today, but is going to disrupt some companies and is going to create winners. But also what ends up happening is, people get excited about themes and they invest for the theme and they invest in a linear way, whether it was the housing market, whether it's the tech bubble building in the 1990s, and they assume the demand is going to be there and they invest for that demand. I'm not saying demand is not going to come, Brian, but that's the risk. You know, if you think about whether it's the data center capacity, whether it's the semiconductor supply that we're building, you know, it's built for this hope and expectation that the demand will come. I do think as we progress, and maybe the time is not now, maybe it's a couple of years from now, but there is a risk that some of the hyperscalers will start to rein in their CapEx, and it's the semiconductor industry that will likely feel the biggest brunt of that. Not yet, but that's a risk.